Executive Program Module 2 Paper 5 Corporate and Management Accounting. Earlier this was known as Company Accounts and Auditing Practices. Now what they did was, in the old syllabus we had two subjects, that is CAAP and Cost Accounting. They merged both and now we have the Corporate and Management Accounting for 100 marks. Let us quickly go through the syllabus once before we proceed towards the actual questions. In corporate accounting, that is for 60 marks, part 1, what we have is Introduction to Financial Accounting, a theory-based chapter, then Introduction to Corporate Accounting, where they say records of accounts to be maintained by a company. Again, a theoretical chapter, but in accounts, since it is objective type now since December 2019, and this will be in fact the second attempt with OMR type of exam or object MCQs, we do not know what kind of questions the institute may or may not ask. So we have to take our chances. I would suggest don't skip these two chapters just because they are theory. Institute can easily ask facts-based questions from these two chapters. We'll come to that in a minute. Then, accounting for share capital. This used to be one of the most important chapters in the old syllabus. Even now, it is still very important, especially with regard to the journal entries. Not that they will ask you to pass journal entries, but if you understand how to pass journal entries, then it will be easy for you to crack this chapter. Then we have accounting for debentures. If you understand chapter 3, understanding chapter 4 shouldn't be that difficult, because whatever principle you apply for issue of shares, the same principles will be applied even when it comes to issue of debentures, except that in case of debenture, we have something known as debenture redemption. So that is the extra part here in chapter 4. Then you have related aspects of company accounts. Again, I would say this can be clubbed easily with chapter 3. This is nothing but the extension of chapter 3, wherein we look at ESOP, buyback, equity shares with differential rights, again theoretical part, underwriting and debentures. I don't know why they mentioned debentures again. Anyway, then financial statements interpretation. Again, a theoretical chapter, but the question may come from any nook and corner of the study material. Then we have consolidation of accounts as per Companies Act 2013. This is very important because there will be few questions based on the practical aspect of consolidation. If you know how to prepare consolidated balance sheet, then you can easily answer questions from this chapter. Then you have corporate financial reporting. That shouldn't be that difficult for you to study and remember. Cash flow statements, there will be few practical oriented questions from this chapter, and mostly practical oriented. I don't think theoretical questions can be asked, but anyway. So that's easy. Actually, we'll come to that when we solve the problems from each of these chapters. Then we have accounting standards, national and international accounting authorities, adoption, convergence. You cannot be expected to understand accounting standards in just 3 chapters. So what I would suggest is just look at the abbreviations and acronyms. So that should pretty much cover everything with regard to those 3 chapters. Then we have the management accounting and valuation part, which is actually more suited for the MCQs. It's easy to ask questions from cost accounting as compared to questions from company accounting, or rather the corporate accounting, because here it's mostly the practical aspect which is more important than the theoretical aspect. Overview of cost, theory, cost accounting records and cost audit, mostly theory, but you have cost sheet there. Budgeting and budgeting control, though there are practical problems, they cannot be asked because they are of descriptive nature. Ratio analysis, very important chapter from the point of view of this type of exam. Management reporting or management information system, you can even skip this chapter, it doesn't really make much difference. Decision making tools, important practical chapter, completely practical. What you can do is you can think of chapter number 19, chapter number 20 and chapter number 22 as one single chapter. In fact, earlier in the old syllabus it was clubbed, but now for some reason they have just split this chapter into different chapters. But basically they all deal with one single concept, that is about valuation. So we have valuation of shares, valuation of company, goodwill also will come into picture here. Again, lots of scope for the institute to ask practical questions in these 3 chapters. Accounting for share-based payments, simply ignore that chapter if you haven't even touched it till now. Anyway, this is about the syllabus. Just remember, 60 marks of questions will come from corporate accounting part and remaining 40 will come from management accounting and valuation. Now, what we will be doing in this video is we'll be picking few questions which I think will be helpful from the point of view of exam, and we'll be solving them. Now the question is, since you have very little time, should you or should you not study this chapter, that is Introduction to Financial Accounting? Now that depends on your background actually. If you are from the commerce stream, that means if you have studied commerce from 11th standard or plus 1, then I would suggest skip this chapter completely, because whatever you have studied in plus 1, the same thing is repeated here in Introduction to Financial Accounting. But if you are from the science background, if you haven't studied commerce at all and you are directly taking up CS executive, in that case, I mean, after passing the foundation, in that case, what I would do is I would suggest you to read this chapter once at least. Of course, I'm assuming that you have already studied this. This is only from the point of view of a revision. So skip this chapter if you're from commerce background, revise this chapter if you're from science background, because whatever is here is self-explanatory. I don't have to explain everything. What you can do is you can quickly check this lesson roundup if you're from commerce stream. If you don't have time at all, let's say you have already studied this once, you do not want to study this again, I would suggest to go through this at least once before the exam. That is the lesson roundup. It will kind of make sure that whatever you have studied is quickly revised. Even if you don't understand anything here, you can just go back to the lesson and verify what exactly is that in detail. Then there are a few questions here. Ignore all these descriptive questions. Maybe you can just, oh, they don't even have objective type of questions. Anyway, doesn't really matter. So that's about chapter 1. Now let's move to chapter 2. Introduction to Corporate Accounting. Here what I would do is, instead of going through the chapter itself, what I will do is I will prepare Schedule 3 format profit and loss statement and balance sheet. So that way it will be a revision for you as to what exactly is a profit and loss statement and how it should be prepared. Now, one thing which you need to observe straight away is it is no longer called the profit and loss account, but instead it is profit and loss statement. This is, by the way, based on Schedule 3 of the Companies Act of 2013. Earlier, it was based on the revised Schedule 6 of Companies Act of 1956, but the same thing is slightly tweaked and presented in the form of Schedule 3 of Companies Act 2013. Revenue from operations is nothing but your sales. This is what we start with. And this is, let's say, the income side. Since it is a statement, it is no longer an account. There won't be any debit side, credit side here. So it's mere statement. So first you will look into revenue from operations, which is nothing but your total sales, and then you look at other income. So both put together will be your total income for the year. Then we look at various expenses. So what is that we start with? First would be purchases. Then what we do here is changes in inventory. See, this changes in inventory is nothing but the opening stock minus the closing stock. Earlier we used to call them as opening stock and closing stock, but instead now it is known as inventory. Then we have the manufacturing cost, various direct expenses which we used to show on the debit side of the trading account. The same thing will be shown here. After that comes the employee benefit expenses. All the salary or any other benefit given to the employees will be mentioned in employee benefit expenses. Of course, in the new Schedule 3 format, or even the revised Schedule 6 of Companies Act 1956, what we do is we don't write in detail as to what are the various purchases you made. What we will instead do is, let's say, we'll add one more column here, notes. It is no longer referred to as schedules, but instead it is referred to as notes. Note 1, let's say, for instance, talks about the purchases. Whatever purchases you have made so far will be contained in this particular note, and the consolidated amount will be written in this column. Then changes in inventory, even if it is a simple calculation of opening minus closing stock, it will be shown by way of a note. Let's say note 2. Then we have manufacturing cost, various expenses directly related to manufacturing if it's a manufacturing unit. Then salary and other related benefits given to employees will be in note 4. Then comes the financial cost. or financial expenses or costs. So that will be note 5. Then what else do we have? Depreciation and other amortization expenses. So that will be in the form of note 6, like depreciation of fixed asset, or maybe something is written off. So all those things will be shown here. And whatever cannot be shown in any of these categories, so that will be considered as other expenses, and a separate note will be prepared for that too. And when you total all this, that will be your total expenses. We earlier saw total income, now we have total expenses. So the next step is actually very simple, profit before taxes. Now what is this profit before tax? It is very simple calculation, total income minus total expenses, that would be your PBT. So if you say profit before taxes, obviously the next step would be deduction of income tax. So then you will deduct income tax from profit before taxes. So whatever is left, that would be profits for the period. So now that profits should be appropriate. Now that profits, that is this profit, should be appropriated. So for that we call it as appropriation. So this appropriation could be in the form of dividend. It could be corporate dividend tax or any reserves as such. So after all these appropriations, whatever is left, that will be carried forward to balance sheet. So this is the format for profit and loss statement. They will of course not ask you to prepare profit and loss statement, but instead they may ask one of these items. So you should know the format. So that's the reason why I just wrote the. You may definitely. It's not that they will ask you to prepare profit and loss statement, but if you know how to prepare profit and loss statement, it will be helpful to answer few objective type questions. Moving on to the balance sheet part. So let's call this the balance sheet of something as at C. Balance sheet is always prepared as on any given date, whereas profit and loss statement is for a given period. So what is the title here? Profit and loss statement for the year ended 31/3/2020. That means for one whole year we are preparing the profit and loss statement. Whereas when it comes to balance sheet of some company as at, that means as on that given date, what is the state of the company? What does it own and what does it owe to various parties? That is what we look into in this case. Every day the balance sheet changes. Now first comes the shareholders funds. Before that, let me write down the title of the liabilities side. It is no longer called liabilities, it is now equity and liabilities. Equity of course is nothing but the owner's funds. In this case, who is the owner of a company? Obviously the shareholder. So the first item on the liability side of balance sheet of a company would be shareholders funds. This shareholders funds is nothing but the share capital itself. So we don't have to write everything in this statement itself, that is balance sheet. What we'll do is we will just create a note for this. So where had we stopped? 7, no? So this would be the next note. Whatever is there, authorized, issued, subscribed, all those things will be written in the form of note. Then comes reserves and surplus. I'm of course using shortcuts here, acronyms. You don't have to do the same in exam. Anyway, you will not be writing anything, so it's okay. Reserves and surplus, again there might be various reserves here. It could be general reserve, it could be depreciation reserve, or it could be some specific reserve. Profit and loss account balance itself, all those things will be shown here. Let's create another note for this. See, now here when we arrived at the profits after the tax or profits for the period, we appropriated some towards reserve, and whatever was left we carried to the balance sheet. So those things will appear in reserves and surplus. Then what else can we think of? Then non-current liabilities. Earlier these were referred to as long-term liabilities. So the same thing is now known by the name of non-current liabilities. Current liabilities you know already. So whatever is not current, so that is referred to as non-current liabilities. All these long-term liabilities, maybe some liability which gets exhausted or which has to be met after 1 year. So those type of liabilities will be referred to as non-current. Maybe let's say a loan for which the period is 5 years, a loan for which the period is 2 years. So all those will be shown here. Even the debentures will be shown in this head, that is non-current liabilities. Then comes the current liabilities. So in case of current liabilities, we have various items actually. So the most common item would be trade payables. Of course, you may wonder what is this trade payables, but this is nothing but the erstwhile creditors. Earlier we used to call them as creditors, but now it is known by a new name called trade payables. Then other current liabilities, it could be some amount outstanding towards the vendors or towards the authorities or whoever it is. So all those items will be shown in other current liabilities. Then there will be short-term provisions. So all the short-term provisions, like what we did here, provision for dividend, then provision for taxation, all those things will be shown in short-term provisions under the heading current liability, because that is something which needs to be met within a short period of time. So everything put together will be the total of the equities and liabilities side of the balance sheet. Then comes the asset side. So we'll have to write down asset here. Then the first category in case of assets would be non-current asset. Just like we have non-current liability, we have non-current assets as well. Earlier they used to be referred to as fixed assets. Of course, even now we have fixed assets, but that comes under the category of non-current assets. Here we call it as fixed assets. Again, there is one more subclassification, that would be tangible fixed assets, something which can be touched and felt. So that is one category of fixed assets. Then there will be intangible fixed assets. So what is this intangible fixed assets? All those things which are something which cannot be touched and felt. For example, goodwill, patents. So all these are fixed assets nevertheless, but they are not tangible fixed assets. Then tangible fixed assets examples would be, let's say, a car or a building or land, whatever it is. So all those things will be considered as tangible. It can be touched and felt basically. Goodwill, patents, they are all intangible assets. Then we have current assets here. Current assets, similar to current liabilities, we have trade receivables. Just like we have trade payables there, we have trade receivables, which is nothing but sundry debtors. Then we have inventories. So what is this inventories? We have already seen this is nothing but the closing stock. We no longer refer to stock as stock, but instead we call them by their new name, that is inventory. Then we have cash and cash equivalents. So this is nothing but cash at bank and cash in hand. So that is referred to as cash and cash equivalents. After that, we have any short-term loans or advances. So if you have advanced any money to someone and if they are supposed to pay you within 1 year, and if there is any short-term loan which you have advanced, so that will also come here. Then whatever is not mentioned here will be shown under the last category, that is other current assets. So you may wonder that this is a very simple form of balance sheet and profit and loss statement. Of course, it is very simple. That was the whole intent of Schedule 3, that is the Schedule 3 of Companies Act. But whatever is there inside this will be shown in the form of a note here. So for example, if in case of non-current assets, so we won't write all the car, building, etc., different tangible assets here itself in the balance sheet, but instead we'll show it in the separate note, which was the last note which we had created, note 9, I guess. So let's say this will be note 10 or something like that. Of course, it depends on company to company and balance sheet to balance sheet. It's not compulsory they should give the same note number in every company or every balance sheet. So this is with regard to the profit and loss statement and balance sheet format, which is in the chapter Introduction to Corporate Accounting. What I would suggest is to pick up one problem and try to solve that problem using this method, wherein you have to prepare profit and loss statement as well as balance sheet. So I would suggest you to do something from the study material itself, because most often students ignore whatever is there in the study material. So please don't do that. Try to solve those questions which are already there, because sometimes the institute asks the question directly from the study material. With regard to chapter number 3, there is accounting for share capital. So the institute in the previous exam has asked a couple of very interesting questions. I thought I would pick those questions and try to solve them for you. This, by the way, is the previous attempt paper. So this is question number 4 of chapter number 3. Shiva Limited forfeited 4,500 equity shares of rupees 10 each, which are issued on 40% pro rata basis. So number of shares issued is 4,500, but they were issued at pro rata basis at the rate of 40%. We all know what is pro rata basis, that is proportionate basis. In this case, when they say 40%, they only mean if you apply for 100 shares, they would have issued you 40 shares on pro rata basis. Now, how many shares has the company Shiva Limited issued? 4,500 to some shareholder. So that means how many shares they would have applied for. So they got 4,500. Once again, if you apply for 100, you will end up getting 40. So if you apply for X, you will get 4,500. So now how do we find out this X? Very simple, just cross multiply. 4,500 into 100 divided by 40 will give us the answer. Now let us do this math. 4,500 divided by 40 into 100. So the company or whoever it is has applied for 11,250 and the company has issued them 4,500. So if you do the quick math of 11,250 into 40%, you will still get 4,500. This is that 40% which is being referred to in the question. Now this is one part of the problem wherein we found out the number of shares actually applied for by the specified shareholder whose shares are now being forfeited. Now moving on, those 4,500 shares are forfeited for non-payment of allotment money at rupees 6, they say, including premium of 2.5. Okay, let me just write down 11,250 somewhere here. The next bit of information which they have revealed is non-payment of allotment money including premium of 2.5 and first and final call of rupees 3. So now we have to find out what is the application money. So rupees 10 is the face value and the premium in this case is 2.5. So the total amount to be paid by the shareholder is 12.5 per share. Out of this, first and final call they say is rupees 3 and allotment is rupees 6. So if you deduct these two, that is 6 minus plus 3, 9, 12.5 minus 9 would be 3.5. So this 3.5 is nothing but the application money. So that is something which we have found out through reverse calculation. If you look at the question here, they have not mentioned the application money. It is up to you to find out how much is the application money. Now, why do we have to find out the application money? Because in this case, someone who is allotted 4,000 shares and who applied for 11,250 shares has already paid application money of 3.50 per share. Now, 11,250 is the number of shares applied for. 4,500 is the number of shares issued by Shiva Limited. And the application money in this case is 3.5, which is the amount paid per share by each shareholder. Now we have to calculate the total amount received from those forfeited shares. So it is not 3.5 into 4,500, but instead 3.5 into 11,250. So let us do that math. 11,250 into 3.5. 11,250 into 3.5 will be 39,375. So this is the amount which we have received from those shareholders towards these 4,500 shares when they initially applied for. But as we already know, this is pro rata basis. We would not have issued everything, but instead we would have used only to the extent of 4,500. So do the math once again. 4,500 into 3.5. This will be 15,750. So 39,375 minus 15,750 is 23,625. This is the excess amount which is paid by those shareholders towards the application money. Now what do we do about this? So that is again easily explained in the question itself. If the excess money received on application is used for receiving the amount due as securities premium, what should be credited to shares forfeited amount? Now 23,625 is the excess amount received. Out of that, only 2.5 per share is utilized towards securities premium. So that will be 4,500 into 2.5, which will come to 11,250. So we cannot touch this 11,250 because it has already been used towards securities premium account. Now what is the total amount received from those shareholders? 33,375. What is the amount which we cannot touch at all since it is already applied towards securities premium account? That is 11,250. So whatever is the difference, that will be transferred to share forfeiture account. So 33,375 minus 11,250. 39,375 minus 11,250, 28,125. So 28,125 is the right answer. See, as you just now noticed, it's not a very easy question. It will require some amount of time. But for this to happen, you should have a thorough understanding of the journal entries and the calculation part of share forfeiture, or rather issue of shares in general. That is about question 4. Now let us look at question 5 as well. That is also an interesting question. In this case, P Limited forfeited 5,000 equity shares of rupees 10 each for non-payment of first and final call of rupees 2.5 per share, which were issued at a premium of rupees 3 per share receivable at allotment, they say. Out of these, 3,200 shares are reissued at rupees 8 per share as fully paid. The amount transferable to capital reserve will be dash. Okay, this is different. In this case, they are asking us about the amount transferred to capital reserve. So this is nothing but share forfeiture account amount, which is not utilized towards discount. So that would be share forfeiture account amount less amount applied towards discount on reissue. So whatever is the difference, this is nothing but our capital profit, and hence it will be transferred to capital reserve account. So we have to do this math and we will get the amount to be transferred to capital reserve. But the problem here is, even though the number of shares forfeited is 5,000, out of that reissued shares is only 3,200. So we'll have to calculate the forfeiture amount only to the extent of 3,200 and then arrive at the amount to be transferred to capital reserve. Because if the forfeited shares are not reissued, then it cannot be transferred to capital reserve, because in future you may reissue those shares at discount. So we do not know at what rate you will issue. So therefore we will not touch those shares which are not reissued. So how do we go about this? First of all, calculate the amount which has been paid by the shareholders whose shares are now being forfeited. So in this case, 10 rupees is the face value and the premium is 13. So both put together it will be 13 rupees. And final call money they say is 2.5. So only this final call is not paid. So if final call is not paid, what we'll do is we'll simply deduct final call amount from the face value. 10 rupees minus 2.5, which will be 7.5. So this is the amount paid towards shares. We cannot touch the amount paid towards securities premium. So we'll not touch this 3 rupees, which is already paid by the shareholders. So now this 7.5 is with us. Towards how many shares? Towards 5,000 shares. Let us do the math now. How much amount do we have in total? 5,000 into 7.5. 5,000 into 7.5. So that would be into 7.5, 37,500. That is the total amount which we have. But we cannot transfer everything towards capital reserve, or we cannot transfer everything to capital reserve, because this 37,500 share forfeiture amount is towards 5,000 shares. Whereas out of these 5,000, only 3,200 are reissued. Now we'll have to calculate what is the share forfeiture amount to the extent of these 3,200 shares out of the amount which is forfeited, that is 37,500. So let us do the math here. If for 5,000 shares the forfeiture amount is 37,500, what would be the forfeiture amount for 3,200 shares? So let's do the math. That would be 37,500 divided by 5,000 multiplied by 3,200, which will give us the share forfeiture amount to the extent of only 3,200 shares, and in this case that amount being 24,000. Now this 24,000 also cannot be directly transferred to share capital reserve, because these shares are already issued at a discounted rate. Now what is the discount rate? So in this case the discount rate is rupees 2 per share. So where is that given? If you look at the last line, out of these shares 3,200 were reissued at rupees 8 per share, they say. That means face value is rupees 10 but reissued at 8, so therefore discount is 2. This discount is nothing but loss. When it comes to reissue, we can always issue shares at discounted rate. So therefore 3,200 into 2 is the loss for us, which is 6,400 rupees. This loss will be compensated by the share forfeiture amount to the extent of 3,200 shares. So how much was that amount? 24,000 minus 6,400. So this will be ultimately be transferable to capital reserve account. So this is nothing but 17,600. So this is the amount which will be transferred to capital reserve. Now that we have taken up the question paper of December 2019 attempt, let us look at few more questions of the same attempt. So if you look at the question number 7, 8 and 9, even 10, these are all facts based question, wherein if you understand or if you know the facts with regard to the law, then you can easily answer these questions. So that's why I often say, when it comes to company accounts, a good knowledge of company law is imperative. If you are studying both the groups, then it would be an advantage. Otherwise also it's important for you to study company law once, so that it will be easy for you to follow whatever is there in company accounts or corporate accounting. Anyway, moving on, there are a few questions with regard to debentures as well, easy questions. In fact, let us look at question number 13, wherein they say C Limited issued 8% debentures of rupees 65 lakhs at 5% discount, which are redeemable at a premium of 10%. Okay, 65 lakhs is the value, that is the face value of debentures, but issued at a discount of 5%. Let me just point it out that right now you can still issue debentures at discounted rate, whereas you cannot issue shares at a discounted rate. That is according to the Companies Act 2013, section 53, by the way. So 65 lakhs shares at 5% discount, that will be 3,25,000 is the discount which is allowed to the debenture holders. On top of that, they also say these are redeemable at a premium of 10%. That means when you are returning the amount, you will not be returning 65 lakhs, but instead you will be returning 65 lakhs plus 6.5 lakhs. So this 6.5 lakhs is nothing but premium on redemption. Now, what is the total loss suffered by the company? So on one hand, it has suffered the loss of 3,25,000 by way of discount, and on the other hand, it has suffered a loss of 6,50,000 by way of premium on redemption. So both the losses put together, it will be 9,75,000 rupees. So this is nothing but the loss on issue of debentures. So now, do we have the answer here in the options? Of course, yes. Option C says 9,75,000. So you have to just select option C as the right answer in this case. Now let us move on to the next problem. That is problem number 15. Yes Limited had issued 80,000 8% debentures of rupees 100 each, redeemable on 31st December 2019 at a premium of 20%, they say. Okay, 80,000 debentures at the rate of 100. So now the important part is in the next sentence. The company offered 3 options to the debenture holders, out of which one is to convert their holdings into equity shares. That means you right now have debentures, but it will be converted into equity. So that is one of the options given to the debenture holders. Now all of them did not opt for it, but instead only 49,275 debentures opted for this option, wherein their debentures would be converted into equity shares. Now We have to calculate how many equity shares should be issued for these holders of 49,275 debentures. So for that to happen, we need to calculate the amount due to them. So 49,275 into 100, that is at par, but there is premium of 20%, so plus 20 rupees. So 49,275 into 120, so that would be the first calculation. 49,275 into 120, this will be 59 lakhs 13,000. But is there anything else which we need to give to them? So this 59 lakh 13,000 is the amount due to those debenture holders. Now we have to issue shares of rupees 10 each, but at a premium of 3.5 per share. That means every share is valued at 13.50. So let us do the math once again. If we have to issue debentures worth rupees 59 lakh 13,000 at the rate of 13.5, how many shares would that be? So 5913 divided by 13.5. So this will come to 4,38,000 equity shares. Once again, we have 49,275 debentures which are to be redeemed at a premium of 20%, which means 20 rupees when calculated on 100 rupees face value. So the amount due would be 49,275 debentures into 120, which comes to 59 lakhs 30,000. 59 lakh 13,000 is now being converted into equity shares. At what rate? At the rate of 13.5 per share, which comes to 4,38,000. So that option should be selected. In this case, that is option A. Now moving on, problem number 16. In this case, it is a problem with regard to X interest and cum interest. I am here assuming that you have already studied all these, but to just quickly tell you about these two concepts. So when I say X interest, it means the company is purchasing its own debentures, but on top of that, it is also paying interest. That's why it's called X interest. Whatever amount the company has paid, on top of that, they will pay interest separately. Whereas when it comes cum interest, the company will purchase its debentures and whatever it pays, let's say X amount, this will also include the interest part. So that is the essential difference between cum interest and X interest. Now in this case, let us see how much profit or loss the company is making while purchasing its own debentures at X and cum interest respectively. During the year 2018-19, the company purchased its own debentures from the open market for immediate cancellation, and it is as follows. On 1st of August 2018, the company purchased 15,000 debentures at the rate of 95.5. This is X interest, by the way. That means the company has to not only pay 95.5 for 15,000 debentures plus interest too. So that means interest has to be paid separately. That's why it's called excluding interest. Now let us calculate the amount actually paid. 15,000 into 95.5 as against its face value of rupees 100. Let's do the math quickly. 15,000 into 95.5. This comes to 14 lakhs and 32,500. So 14 lakh 32,500 is the amount to be paid to debenture holders as against 15 lakhs if they had paid the actual face value, which is 100. Now the company obviously is paying less, so therefore the company will make some profit. So 15 lakhs minus 1432 is nothing but 67,500. So this is with regard to sub question 1. Now let us look at the profit which the company makes with regard to sub question 2. That is, on Jan 1st 2019, the company purchased its own debentures of 25,000 at the rate of 101.5 cum interest. So now here we have to be careful, because if it is X interest, we need not worry about the interest part, because anyway we'll pay it separately, so that will not come into picture at all. Whereas if it is cum interest, this 101.50 also includes the interest due for the unexpired, or rather expired period. What is the expired period here? Expired period here refers to the difference between the date of redemption and interest last paid. So when was the interest paid? The last, or rather the previous interest was paid on 30th September. When is it being redeemed? On Jan 1st. That means there is a gap of 3 months. So for these 3 months, the company has to pay interest. Since it is cum interest, this 101.50 includes the interest due for those 3 months. So how much is that? We'll have to calculate that. So that will be 25,000 into 100. Interest to be always calculated on face value, which comes to 25 lakhs into what is the interest rate here? 12%, right? So let us do this math first. 25 lakhs into 12% into 3 divided by 12, since it's only for 3 months, which will be 75,000. So this is the amount which has to be paid separately normally, but in this case it won't be paid separately because it is cum interest. So now we have to calculate the amount actually paid. Amount actually paid is 25,000 debentures into 101.5. So how much would this be? 25,000 into 101.5. So the company actually paid 25 lakhs and 37,500 instead of 25 lakhs 75,000. How did we get 25 lakhs 75,000? Very simple. 25 lakhs they would have anyway paid because it is the face value, plus the interest which they were supposed to pay, which is 75,000 for the expired period of 3 months. So both put together, the company should have actually paid 25.75, but instead they paid 25.37.5. So what is the difference now? 25.75 minus 25.37.500, which is nothing but 37,500. So this is the amount of profit which the company is making due to subquotient number 2. Now what is the total profit which the company has made? In case of subquotient 1, the profit which the company made was 67,500. In case of subquotient 2, we just now found out it is 37,500. So if you add both, you will get 1,05,000. So this is the actual profit which the company earned out of this purchase of its own debentures. Now these are the kind of questions about which you should be careful, because you may go wrong here in any of these steps. Even if one of the steps is incorrect, the end answer will also be different and you will simply end up picking the wrong option. Whereas when it comes to theory questions like 17, 18 or rest of them, it's very easy to answer those, because all that you need to do is just remember or recall the facts and click the, or rather mark the right option. So I am not be touching the easy questions and also the theoretical questions here. I am only looking at the questions which are slightly difficult in nature. Let's look at question number 19. It's a slightly tricky one. Return on value of a machine as on 31st March 2019 is 6,65,558, they say. So this is the WDV after writing on depreciation for several years. Now they say the rate of depreciation in this case is 15%. What will be the cost of this machine purchased on 1/4/2014? Okay, 31/3/2019 WDV is this much. Their question is, how much would be the cost if it was purchased on 1/4/2014? Okay, so let me, for a fact that WDV is calculated like this. Let's assume that the cost of the machine as on 1/4/2014 was rupees 100, and depreciation for that year would be 15, because first year 15 rupees on 15% on 100 would be 15 rupees. So WDV as on 1/4/15 would be 85. Now we'll have to use calci henceforth. 85 into 15% will be 12.75. So that would be the depreciation for the second year, minus 85 will get us 72.25, which is WDV for 1/4/2016. Then again 72.25 into 15, 72.25 into 15%, which is 10.8375. 10.8375 minus 72.25 will be 61.4125. So this is the WV as on 1/4/2017. Again into 15%, which will be 9.211875. So now 61.4125 minus 9.211875. So this will be 52.200625, which is the WV as on 1/4/2018. Then further calculate 15% on this, so which will be 7.83. I'll just write down 1, round it off. So now 52.200625 minus 7.831, which will be 44.369625, which is WV as on 1/4/2019. So finally we are here. Now if you go back to the question, so the WV which they have given is as on 31/3/2019 or 1/4/2019, more or less the same thing. So now if 100 was the cost as on 1/4/14, WDV as on 1/4/19 is 44.369. So if that is the case, what would be the cost if the WDV was 6,65,558 as on 31/3/2019? So we'll have to do the simple cross multiplication. Let us do that here. If 100 is the cost, WDV as on 1/4/19 is 44.369625. If the cost is X, how much, WDV as on 1/4/19 would be 6,65,558. Now how much is that X can be found out by cross multiplying. So we'll have to bring up calci here. 665,558 into 100 divided by 44.369625. So which is 15 lakhs. Okay, we'll round it off because there will be some rounding of error. So we have some 30 rupees extra. So if you look at the answers here, do we have 15 lakhs? Anything which is close to that amount which we calculated or arrived at, so that should be considered as an answer. Here the closest amount is 15 lakhs. So therefore we'll consider the WDV of this machine, or rather the purchase cost of this machine to be 15 lakhs based on this calculation. So what we did was we worked back and we arrived at the amount, that is 44.369625 if the cost was 100. So likewise we already know the WDV as on 31/3/2019 or 1/4/2019, one and the same. So if that is the case, how much would be the cost? So when we do the math, we will get 15 lakhs as the answer. So you can do one thing, you can check this by starting with 15 lakhs as the original cost, and from that reduce 15% every year using WDV method. You should end up with 665,558. Moving on, I'll not be looking at all these facts based questions. This you can easily answer. There's nothing much which I need to explain. Okay, let us look at this question. These are all facts based. Okay, 26. This question number 26 is with regard to consolidation. So here is a question with regard to minority interest. Now, how many shares are there? So in this case, we have 20 lakh shares of S Limited, of S Limited, out of which 16 lakh equity shares are purchased by H Limited. So that means how many shares are left? Only 4 lakh shares. So this 4 lakh into 10 rupees, since the face value is not given, we'll assume it to be 10. So that comes to 40 lakh rupees. This is the face value. Okay. Then what else? General reserve. How much is the general reserve? 45 lakhs. On this 45, all you have to do is calculate 20%. So be it, will come to that in a minute. Then we have statement of profit and loss, which is 32 lakhs. This also, on this also you'll have to calculate 20%, because if 4 lakhs out of 20 lakhs is minority interest, that is nothing but 20%. So 4 by 20 into 100, so that is the minority interest, and holding company stake is 80%. Then there is one adjustment here. On 1st April 2019, a machine of S Limited was revalued by H Limited 25% above its book value of 1215. Okay, that means there is some reserve or revaluation reserve. 12,50,000 was the original cost. On that, you'll have to add 25%. 1250 into 25% will be 312,500. So this is nothing but the profit to the company. So now we'll have to calculate the total of this and just calculate 20% of that. So this will be 5080. 80 12 500 into 20% would be minority company stake. So 80 12 500 into 20% comes to 16,02,500. 16,02,500 plus the face value, which is 40 lakhs out of 2 crore worth of share capital. So this comes to, why do we need to calculate? 56 lakhs 2,500. Do we have that as answer? Yeah, option number D, 56 lakhs 2,500 is the right answer. Again, if you look at these questions, these are all facts based or knowledge based questions. All that you need to do is understand the question and just click the right answer. So there is nothing much for you to calculate as such. So you should not be wasting too much time on all these questions like 33, 34, 35, 36. All these are knowledge based questions. If you know the facts, you will be able to answer. Otherwise, you'll have to simply guess. Now again, there is one more question regarding forfeiture. I won't touch that. It looks like an easy question. Okay, let us look at this question from Corporate Financial Reporting. Question number 38. The capital structure of KC Limited is equity share capital 250 lakhs, then long-term debt 110 lakhs, then bank OD is 40 lakhs. So the total capital including the debt comes to 400 lakhs. Now each of these category of amounts has its own interest or cost. The average rate of return on similar type of companies is 20%. That is on equity it is 20%. Then they say risk-free return is 10%. So we'll consider that as long-term debt rate. So risk-free return 10%. Then bank OD is 18%. So this would be bank OD 18%. Now based on this, we'll have to calculate weighted average cost of capital. Let's do the math. Let me write it down here separately. 250, 110 and 40 all put together it is 400. Now what is the percentage of all the three or in total debt? So 250 by 400 into 100. 250 divided by 400, percentage will be 62.5 is equity. 110 divided by 4, this would be 27.5 and this will be 10. So this is 100. Now write down the cost next to it. Cost of equity is 20. Again, this is also in percentage. Then risk-free rate of long-term debt is how much? 10% and interest is 18. Now multiply this into this. That would be 62.5 into 20. So 1250. 27.5 into 10, that 275. Then this is 180. So all the three put together, it would be 1250 plus 275 175 plus 180. 1705. So this 1705, if you divide by 100, it will be 17.05%. This is the weighted average cost of capital, and we have option D, 17.05. That is in fact the right answer. Now let us look at this final accounts based question number 43 here. Balance of provision for taxation as on 1/4/2018, that is the opening balance, is 13,72,000, whereas the closing balance of provision for taxation for the same year is 14,55,000, they say. And they also say during the year tax paid is 12 lakh and 5,000. If this is the case, how much is the provision made during the current year? A very simple question. All you have to do is just prepare the profit and loss, or rather provision for taxation account. Let me prepare that. Provision for tax account, it's a ledger account, debit and credit sides. Now if I have to bring down the balance, it will be on the credit side because it's a liability. By balance brought down, how much was opening balance? 13,72,000. So then closing balances, to balance carried down 14,55,000. So this is the case. Now how much tax did they pay during the year? 1205. So to bank 12,05,000. So now add these two. 1205, that means 2660 would be the total. So 2660 minus 1372, that would be by P&L for provision for taxation. So let's do that. 2660 minus 1372, this will be 12 lakh and 88,000. Do we have that as option? Yes, option B is in fact the right answer. Now if you look at question number 47 to question number 60, it's from the chapters, the last 3 chapters in corporate accounting, which is mostly related to accounting standards, and these are all facts based questions. That means you don't have to understand any concept there. All you have to do is just remember, like, which of the following index is related to consolidated financial statements. Now instead of ICA is a professional body, whether it's the largest, second largest, etc. in the world. So these things can be easily memorized. All you have to do is just extract facts from those last 3 chapters. Now this ends the part 1 of the revision of CMA. In the next part, we will be taking up questions from the part 2 of the question paper, that is from the management accounting side. Now let us move on to the part 2 of the question paper, which is the management accounting part. So as I did in corporate accounting, here also I'll be ignoring the theory questions because it's all based on your memory. So there is nothing much I can do about your memory. So I would suggest please go through the theoretical questions again and again so that you will retain the facts in your mind. Anyway, let's get on with the questions here. We have a practical question here in the form of 66. It's a very simple, straightforward question. What they've asked is, if capacity ratio, this is from ratio chapter, capacity ratio, they say, is 95% and efficiency ratio is 125%. So that is given. Then what is that which they have asked? They have asked, then what would be the activity ratio? So we already know that capacity ratio into efficiency ratio will give us the activity ratio. All that we need to do is multiply this by this and you will get AR. So let's try to do that. 95 into 125 percentage, 118.75. So 118.75% would be our activity ratio. As I said, even here it all depends on how deeply these ratios are ingrained in your mind. If you forget the ratio formula, then there is nothing which you can do about this type of problems. Anyway, let's move on. Question number 67 is also with regard to practical aspect. Let us quickly go through that once. Following information estimated for the year 2021. Okay. Normal loss in production will be 5% of the input. Sales in units as per the sales budget 38,350 units. Closing stock will be 6,600 units, which has been estimated 10% more than the previous year's quantity. The input for required production will be dash. So now this is a very simple budget. What we have to do is we'll start with the given information. Let me draw a profit and loss account, not required actually, but it will make our life easier. So sales budgeted unit is how much? 38,350. Then the closing stock which is given in the problem is 6,600. Now let us total this first. So this will be 950 and this will be 444, 950. Now have we got any information regarding the opening stock? Of course, yes. If you look at the last line of the problem, they say closing stock will be 6,600 units, which has been estimated 10% more than the previous year's quantity. That previous year's quantity is nothing but previous year's closing stock. We know for a fact previous year's closing stock will be current year's opening stock. So therefore, but opening stock is nothing but 6,000, because if you add 10% to 6,000, it will become 6,600. Now all that we are left to find out is the production. So in this case, how much was produced? So now 44,950 minus 6,000, that will be 38,950. But one thing which we have to understand here is there is some normal loss in the production. Normal loss is 5%. After this loss, it is 38,950. So before loss, how much was it actually? So that is the input we are referring to. So now they would have input something. Out of that, 5% is lost forever. So whatever is left is used for production. Now if 100 was input, 5% is lost and 95 is used for production. We know this 95. In our case, this 95 is nothing but 38,950. If 95 is 38,950, how much would be 100? So this is the simple math which we need to do now. 38,950 divided by 95, which will come to 41,000. After cross multiplication, we get that the total input in this case is 41,000. So that is the answer. Moving on. Okay, there is one more simple question, not simple actually. It involves some bit of calculation. PUVI Limited provides the following information for the quarter ending 31st March. Okay. So they have given sales for Jan, then Feb and March. And also the amount 25 lakhs, 28 lakhs and 30 lakhs. Roughly 40% of the sales are for cash and 80% of the credit sales are collected in the month following the month of sales, and the balance of the credit sales 1 month after that. The amount collected from debtors in the month of March is how much? So that is the question. If 40% of the sales is cash, then how much is credit? So that is easy. That will be remaining 60%. So 25 lakhs into 60%, 28 lakhs into 60%, and 30 lakhs into 60% will give us the credit sale for the respective months. So let us do that math. 25 into 60% would be 15 lakhs. Then 28 into 60% would be 16.8 lakhs, and lastly 30 into 60%, 18 lakhs. Now out of this, 80% is received in the following month. So this 15 lakhs is nothing but credit sales. Out of 15 lakhs, 80% is received when? In the month of Feb, and remaining 20% of 15 lakhs is received when? In the month of March. So 15 into 80% would be 12, which we will receive in Feb, and remaining 3 we will receive in March. This is with regard to January's credit sales. Likewise, when it comes to Feb, 16.8 into 80% we will receive in the next month, that is March, 13.44. Remaining we will receive in the month of April, which is not required for this problem. So how much did we receive in the month of March from the debtors? We received 13.44 of February and 3 lakhs of Jan. So in total we received 16.44 lakhs. We'll see if that is in the answer. Yeah, option D is the right answer, 16.44 lakhs. Moving on. Again, there are theoretical questions. I will not be looking into that. Okay, we have very simple questions from ratio analysis. All that you need to do is just memorize the formula and apply that here. But let me do one problem for you. Question number 70. N Limited has net working capital of 119 lakhs. So net working capital is 119. So we know the formula for net working capital, which is nothing but current assets minus current liabilities. In this case is 119 lakhs. That is what we are told. Total liabilities 225 lakhs and non-current liabilities are 140 lakhs. Okay, this will give us a clear picture. Total liabilities, they say, is 225 lakhs. Out of that, how much is non-current? 140. So that means the rest are current liabilities. So let us do that math. 225 minus 140. So current liabilities amount to 85 lakh. So now we know current assets minus current liabilities equals 119. So out of this, current liability is already known. So 85 lakh I'll substitute here equals 119. So therefore current assets will be 85 plus 119, which will be 204. Now let us look at the next half of the question. They have asked us to find out current ratio. See, this current ratio is very simple. Current ratio is nothing but current assets by current liabilities. Current assets is 204, current liabilities is 85. That's it. If you do the math, you will get the ratio. 204 divided by 85. This is 2.4 is to 1. This is the ratio, option A in this case. Moving on. Again, there are a few ratio problems. Please do that. It's all just application of formulas. So when it comes to ratios, again, you'll have to memorize all these formulas. So I would suggest, if you have not memorized anything, at least memorize 10 ratio formulas now. You may or may not get questions from those 10 itself, but it is better than not learning anything. So this is only for those who have not touched that chapter at all. Next, these are all, of course, theory questions. I won't touch them. Okay, next, 79. This is interesting. Following data provided by M Limited. Okay, this is from marginal costing chapter, by the way. So now what they have done is they have given data for first 6 months and second half or last 6 months. Now profit is mentioned. Okay, 10 lakhs and 14 lakhs. Likewise, cost of sales is also mentioned. 70 lakhs and 76 lakhs. We are supposed to find out the fixed cost. This is not so direct. We'll have to find out something else to finally arrive at fixed cost. So what we will do is we'll find out the change in sales. First of all, we need to find out the sales, right? Okay, sales will be nothing but profit plus cost. So what is the profit for the first half? It is 10 plus cost of sales is 70. So the total sales for the first half is 80 lakhs. For the second half, it will be 14, that is profit, plus 76, which is cost. So 90 lakhs. That means profit has, the sales has increased by 10 lakhs in the second half. Now what we can do is we can find out the PV ratio. So how do we find out the PV ratio? Very simple. Change in profit divided by change in sales into 100. What is the change in the profit from first half to second half? That is nothing but second half profit minus first half profit, which will be 4 lakhs. What is the difference between second half sales and first half sales? It is 90 lakhs minus 80 lakhs, which is 10 lakh sales into 100. So 4 by 10 we know is nothing but 40%. So now we know the PV ratio. With the help of PV ratio, we should be able to find out the fixed cost. Fixed cost is nothing but total sales into PV ratio minus the profit. So how much is the total sales? We just now saw it is nothing but 80 plus 90 lakhs, which will be 170 lakhs. PV ratio we also calculated now, 40%, minus the profit. So what is the overall profit? Overall profit was 24 lakhs, which is nothing but 10 plus 14. So now we have to do this math. 170 lakhs, which is nothing but the total sales, multiplied by PV ratio. 170 into 40%, which is nothing but 68 minus 24. So that will be our fixed cost. So let us say 44 is in the option. Of course, yes, this is option D. So 44 lakhs is our answer. Okay, in this problem number 82, what they have given is a fixed cost, which is 24 lakhs, and BEP, which is 60 lakhs. This is the information which is relevant for us. Now this BEP will have both variable cost as well as contribution. So let's say variable cost and contribution, and this contribution will have both fixed cost as well as profit. But since it is BEP, profit will be 0. Okay. And fixed cost is already given, which is 24 lakhs. So we know for a fact that contribution minus fixed cost equals profit. Since it is BEP, profit will be 0. So therefore, contribution minus 24 lakhs is 0. So therefore, contribution will also be equal to 24 lakhs. So this is something which we have ascertained. That is, contribution is 24 lakhs. Now, one thing which we can ascertain using that information would be PV ratio. So that would be contribution by BEP. So how much was the contribution, which was 24? BEP is given as it is 60. So how much would this be? 24 divided by 60 equals 0.4. So that is our PV ratio, or 40%. Now using this information, we can find out other details. So now what is that which we are supposed to do? When sales are rupees 120 lakh, then calculate the profit. Okay, let's do that. So let us start with sales itself. Sales equals 120 lakhs. Okay. Or let me just write down sales equals 120 minus a variable cost equals contribution. In this case, we already know how much it is, that is 40%. So 40% of 120 will be 48. So this 48 is nothing but our contribution. So 60% will be variable cost. So we need not even calculate, because directly we have arrived at contribution. So from this contribution, deduct fixed cost. Fixed cost we already have, that is 24 lakhs. It won't change anyway. So contribution 48 minus fixed cost 24 will be our profit. So profit is 24 in this case. So do we have that as option? Yes, of course, option C is the right answer in this case. Moving on, question number 83, 84 and 85, those are all theory based questions. I'll just give it a miss. Then 86. Now in this case, they're talking about the present value of money, because they have given the present value factor of 7% for 4 years and 6 years. Let's read the problem. A deposit is to be made on 1st Jan 2020. Okay. Into bank that will earn an interest of 7% compounded annually, they say. Okay. So 7% is the rate of interest. It is desired to withdraw 60,000 on 31st December 23. So future value of the money is given. Future value of the money in this case is 60,000. This 60,000 is when? It will be on 31/12/2023. So from this date to this date, how many years will that be? So that will be 31/12/2020, then 2021, 2022 and 23. So it will take 4 years for something to be value of 60,000 in future. So how much should you invest to get 60,000 right now? So that is what we are supposed to calculate. That is easily done. So what we can do here is 60,000 is the future value. Apply the present value factor for 7% for 4 years. So we need not have to calculate this. It's already given there. So 60,000 into 0.7629. If you do that, you'll get the answer to 60,000 into 0.7629. This will be 45,774. 45,774. This is with regard to 60,000. But there is one more part. and 1 lakh on 31st December 2025. So that will be 6 years from 1/1/20 to 31/12/25 is nothing but 6 years. After 6 years we will get 1 lakh, that is the future value. So 1 lakh into what is the present value factor for 7% for 6 years, that is 0.6663. so if you do this math, it will be 66,663. No, I missed something, I guess. 66,630. So this is what you have to invest to get 1 lakh after 5 years. So now if you add both, you will get the right answer. There is a total amount to be invested. 45,774 plus 66,630, both put together it is 1,12,404. This is the total amount which you need to invest now to get 60,000 after 4 years and 1 lakh after how many years? 6 years. So option B is in fact the right answer. Moving on. What else do we have? Okay, question number 88. Following information provided by B Limited. Okay, earnings per share they have given, it is rupees 75. Company's dividend payout ratio is 40%. Required rate of return on investment is 18%. By using capitalization earning method, the value of equity will be. Okay, fine. So if dividend are expected to grow at the constant rate of 10% per annum. Okay, this is easily done. All that we have to do is just apply the formula. Now we know for a fact that dividend paid will be nothing but 75, that is EPS into dividend payout ratio, which is 40%. So EPS into 40% or dividend payout ratio, 75 into 40% will be 30 rupees. So this is the dividend which is paid. Now what is that we are supposed to find out? We are supposed to find out the price. Price of a share is nothing but, this is the formula, D1 by KE minus G. K is already given here, that is 18%. Growth rate is also given somewhere in the question. Growth rate they say is 10%. This is G. Now do we have D1? That is something which we do not have. That is dividend at the end of the year. That can also be easily found out. So D0 is 30. That is dividend at the beginning of the year, plus expected growth is 10% anyway. 10% on 30 is how much? 3. So dividend at the end of the year will be 33. So now that we have that, we can easily find out the price of the share. So P0 equals 33 by K is 18% minus growth rate is 10%. So this will be 33 by 8%. So that will be the price of the what is that share. So 33 divided by 8% is nothing but 412.5. so is that the value of equity in this case is option A. Next, question number 89. What do we have here? P Limited has 12% debentures of 40 lakh and 13% debentures of 60 lakh. If the corporate rate is 30%, then combined cost of debt after tax will be dash. Okay, we have two different types of debentures, no? So 40 lakhs, that is 12% this, okay. So that will be 4,80,000. Then 60 lakhs worth of debentures into 13% interest rate. So 7,80,000. So this is the total value of interest to be paid. So this will be 12,60,000. Now can we say this is the combined cost of debt? We cannot say that, because there is something known as tax advantage. So this is helping us save the tax to the extent of 30%, whatever is the tax rate, by the way. So now 12,60,000, from that let us remove 30%. So that will be the actual cost of debt, not the amount of interest paid. 12,60,000 minus 30%. How much is that? 12,60,000 minus 30%, it will be 8,82,000. Do we have that as an answer? Okay, 8,82,000 is the amount. Okay, that is in percentage. No, that's not an issue. So total debt is how much? 40 lakhs plus 60, which will be 1 crore. So 8,82,000 total cost of debt in value divided by total debt in value into 100 will give us the percentage of debt, rather the percentage cost of debt, which is nothing but 8.82%. So option C in this case is the right answer. Moving on. Okay, yeah, question number 91. Following information is provided by A Limited. We have preference share capital, equity share capital, reserves and surplus, external liabilities, then average profit after tax is given. The normal return earned on the market is given. Assume the 2% of total assets are worthless. So what is that they want? Okay, the intrinsic value per equity share will be dash. Okay, this is based on formula actually. Intrinsic value is nothing but net assets available to equity shareholders. This is important. Net assets available to equity shareholders divided by number of equity shares. So this will give us the intrinsic value per share for the equity shareholder. But do we have the net assets here? We do not even have the balance sheet. But how do we find out the net assets? That is the question. Okay, see, this net assets is nothing but total assets minus the liabilities. Okay, if you think of a balance sheet, this will be the total assets, and let's say this is the liabilities. So this minus this is our net assets. That means it is nothing but net assets minus total liabilities is, or rather, total liabilities is nothing but the capital itself. So if you have the data with regard to capital, you can as well say that itself is net assets. So now, can we find out net assets using the other way around? Of course, yes, because we have the capital data. Let us try to total all the capitals which we have. So that would be preference share capital plus equity plus reserves and surplus. So 200 plus 600 plus 270. So this will be 800,070 will be my net assets. Now this divided by what is that, equity shareholders. Should we do that? Of course not, because there is some adjustment here. They say assume that 2% of the total net assets are, total assets are worthless. But do we have total assets? No, we only have net assets. Now how do we find out total assets? Again, we'll have to look at the external liabilities. Okay, we can do one thing. Total assets minus external liabilities equals capital, right? So total assets we do not know, minus external liabilities we know 480, capital is 1070. So x will be 1070 plus 480, which will be 1550. So this will be my total assets. So this will be my total assets. But we have some additional information wherein they say assume the 2% of the total assets are worthless. Okay, 2% of this they say is worthless. Okay, we will deduct that. Okay, and we have to find out the intrinsic value. Okay, let's move ahead with this information. So net assets 1070 minus 2% of 1550. So how much would that be? 15.5 into 2 will be 31. So straight away deduct 31. Then also deduct the preference share capital, because preference share capital cannot be considered here because we are only calculating the intrinsic value of the equity shareholder. So how much is the preference share capital in that net assets, which is nothing but the capital? It is to the extent of 200. So deduct that 2. So that will be 1070 minus 231, which will be 839. So this is the net assets available to equity shareholders. Now if you divide this by the number of equity shares, so how many equity shares do we have? 60. Everything is in lakhs, so therefore just don't write 60 lakhs. So 839 lakhs anyway this is. So 839 divided by 60 will be 13.9833. So that is the intrinsic value of share, that is equity share. So do we have this answer? Yeah, option B. Let's move to question number 94. It's based on goodwill, or rather valuation chapter. Average profit is given, super profit and also capital employed of a firm is given, then normal rate is given. Value of the goodwill on the base of capitalization should be found out for both average profit as well as super profit. Okay, let us do one thing. Let's write down the formula first. So average profit capitalization would be nothing but FMP, that is future maintainable profit or average profit itself, divided by NRR, that is normal rate of return, into 100. Then deduct capital employed. So if you do this, you will get the goodwill based on capitalization of average profits. So this is with regard to average profits. But when it comes to super profits capitalization, that's a very simple formula, wherein goodwill will be goodwill equals super profits divided by capitalization rate or normal rate of return into 100. That's it. So now using these two formulas, let us try to find out the value of goodwill. So let us start with the capitalization of average profits. So FMP. So do we have average profits? Of course, yes. Divided by NRR into 100. Let us first do this. FMP is how much? 15,60,000 divided by how much is the NRR? 12% into 100, or just write 12. That's also fine because anyway we have written 100 here. So this will be 15,60,000 divided by 12%. So which is 1 crore 30 lakhs. Okay. Minus the capital employed. How much is the capital employed? Capital employed, which is given in the problem, is 90 lakhs. So 1 crore 30 lakhs or 130 lakhs minus 90 lakhs would be 40 lakhs. So this is our goodwill based on capitalization of average profits or future maintainable profits. So that is one part of the question, because the other part concerns super profit capitalization. So let's do that now. So goodwill using super profit capitalization would be super profit itself divided by NRR into 100. That's it. Super profit is how much in this? 4,80,000. Okay, 4,80,000 divided by 12 into 100. So 12 fours are, so which is nothing but 40 lakhs. So once again we have the same answer as capitalization of average profits. Even under capitalization of super profits we got 40 lakhs. So the answer would be 40 lakhs and 40 lakhs. Option D would be the right answer. Moving on, question number 96. The risk-free rate is 8%, return on broad market index is 15%, the actual return provided by the security is 18%. What must be its beta? By using CAPM, if the security is correctly priced in the market. Okay, we have to find out if it is correctly priced using capital asset pricing method. Okay, that's fine. So for this we'll have to use the formula. That's it. So what is it we are supposed to do? We are supposed to apply the formula and calculate beta there. That's it. So CAPM formula we know, in this case we are looking at return, by the way. Actual return will be nothing but risk-free rate plus beta into a market rate minus risk-free rate again. So actual return is already given in the question, which is 18. Risk-free rate is also given in the question, which is 8, plus beta, something which is not there in the question, and market rate, that is RM, is how much? 15 minus risk-free rate, which is 8. So this will be nothing but 18 equals 8 plus beta into 15 minus 8, 7. So simplified way would be 18 equals 8 plus 7 beta, or 18 minus 8 you can do. So then that will be 10. So this will be nothing but 7 beta. So beta will be 10 by 7. So how much is 10 by 7 now? 10 divided by 7 will be 1.428 or 1.43 is the answer. So do we have that as answer? Of course, yes. Option A is the right answer. So moving on to the last practical question, that is question number 98. Following are the details of Beta Limited. Okay. Equity share capital is given, preference share capital, fine, debenture and other things is given. Let's read the question first. Okay, earnings per share is to be calculated. Okay, earnings per share is nothing but earnings available for equity shareholders. Equity shareholders earnings divided by number of equity shares. So what do we have? The earnings available for equity shares we do not have, so that we have to calculate. So how do we go about that? So that is simple. We can start with PBIT, which is given in the question itself. That is profit before interest and taxes. How much is that? 590 minus interest. So interest is nothing but 12% interest on debentures. So 250 is the debenture value. On that, calculate 12%, that will be 30. So remove that, you'll get 560. This will be profit before taxes. Now less tax rate, the rate of how much is tax rate? 30% they say. So 560 into 30%. This will be 168. So if you remove that, you'll get 392. So this is profit after tax. But is this the earnings available to equity shareholders? Obviously not, because we have to give dividend to preference shareholders. So how much is the dividend rate? 8% on 400. So 4 8s are 32. So this will be 360. So this is nothing but the earnings available for equity shareholders. Now that we have found out the earnings available for equity shareholders, to calculate EPS would be very easy. So EPS is nothing but earnings, which we just now found out, available for equity shareholders divided by number of equity shares. Earnings was 360 lakhs divided by equity shares also in lakhs. So share capital is 1500 lakhs, no, divided by 10 will be 150 lakh. So this will be our EPS. 360 divided by 150 equals 2.4. So this is the earning per share. So that's about the revision session for CMA. What we have done is we have just looked at a few of the questions from the previous attempt. The reason why I did so was most often what we do is we study for a period of few months and then we forget the actual exam itself as to how to approach the exam. So I hope this video would have helped you at least to revise the concepts which you have already studied. If you're studying this for the first time, I don't think this will help you at all in any way. But assuming that you have already studied, so this will be like a quick recap or revision before you proceed towards the exam. So whichever concept you have forgotten, or maybe if something is stuck somewhere, hopefully this video helped you to clear certain things. Do well and all the best for your exams.